All right. Good afternoon, everyone, and thank you for joining us today. My name is Ben Brown, and I'll serve as your moderator today for this webinar titled Navigating the 2025 U.S. Economic Landscape and Its Impact on Agriculture. It is a pleasure to be joined today by our good friend, Dr. Courtney Cowley. She's an assistant vice president and branch executive of the Federal Reserve Bank of Kansas City. Last week, we covered the timely topic of fertilizer markets. The week before that, we covered another timely topic in poultry and eggs and dairy prices. And today we have another topic that I think will be of interest to people around consumer influences in the macroeconomy and the implication for agriculture, land values, and credit conditions. Today will certainly be an informative discussion about current issues facing Missouri crop and livestock producers, and I hope you all are excited about it as well. Couple of announcements before we get started. As always, we will have a period of question and answers at the end of today's program. We encourage you to submit as many questions as you would like, either by name or using the anonymous function. Questions can be submitted at any time using the Q&A feature at the bottom of your screen. If you do not see a Q&A logo, hover the mouse near the bottom of the screen and a toolbar should appear. You can also email questions to me at bpbrown@missouri.edu. Questions will be asked at the end of today's program. Our goal is to answer as many questions as we possibly can. However, if we do not get to all of them, we will put them on our program webpage to be viewed later. Speaking of our webinar website, the location for unanswered questions, slides, and upcoming webinars can be found at the link that you see there, found at fapri.missouri.edu, and then select the Event 25 Ag Lender Webinars tab at the top. Each webinar has a spot for clients to register if you would like to attend or share with your own clients if they would like to attend for themselves. I have 3 asks for you today. I ask that you be engaged in this presentation by following along and asking questions. I ask that you share this information with others in the food and ag industry. And I ask that you fill out the evaluation at the conclusion of today's webinar. And I'll also put the link in our chat feature, and it'll be included in the follow-up email you'll get tomorrow. Program evaluations are important to us. I know you get tired of answering University of Missouri Extension webinars, but we do value their results to help identify topics of future relevancy to attendees, to provide information that we can use to compete for program support dollars, and just to help to identify education objectives. This evaluation is anonymous. It'll launch in your browser at the end of today's webinar. If you know you'll have to leave early, please budget 3 to 5 minutes to complete the survey. This is the third of our spring University of Missouri Extension educational webinars planned for stakeholders of the College of Agriculture, Food, and Natural Resources, such on topics of macroeconomy, planting conditions, commodity markets, policy issues, input costs, value-added agriculture, and Missouri farm income. We encourage you to hold these dates to enhance your farm management skills and those of your clients and stakeholders ahead of the 2025 season. A recording of the first 2 webinars on poultry and dairy markets and fertilizer can be found at this website as well. So to start off today, I do have a poll question that I'm going to ask of everybody. So I'm going to go ahead and launch that. The first question relates to what is the most common reason for agriculture loan applications being denied? And you have a couple of opportunities here to answer: for credit history, insufficient collateral, high debt to asset ratio, lack of business planning, something else, or unsure. And so I'm going to give you a few seconds here to answer this poll. And Courtney, I guess that this is my message that if you want to answer these, you're welcome to when we turn it over to you as well. But hopefully you find some information out of this too. And I see we have 2 Bs listed. That's my fault. There shouldn't be 2 Bs listed on the slide, but we'll give you just a few seconds here to get your responses in, and then we'll get rolling. All right, I think we're getting close. Last call here. All right, so the results here, most of you say high debt to asset income. Certainly, all of them do contribute to loan applications being denied, but that is a common one. So that was the first one. We've got a second one here. So the second one, oh, nope, I skipped it. Sorry. What do you believe is the main factor influencing land values? And we've got some options here. And so I'll launch the poll. Your options are market demand from farmers, market demand from investors, urban development, electricity and utility generation, government policies, both financial support, either through direct payments or crop insurance or other types of government support payments, or F, unsure. So I'll give you just a few minutes here to answer this question, and then we'll share the results as well. Okay, I think we're there. So last call. All right. And so for many of you, the answer was market demand from investors. And certainly that is having an impact in land values. A lot of our data that we would have here at the University of Missouri and in the state still suggests that farmers are the largest buyers of farmland, but investors do play a role in that as well. And then I have one final question. And so this question is, how vulnerable, here, let me launch the poll, but how vulnerable are Missouri farmers to significant solvency problems? And so in this, I have forced bankruptcy listed, but I would also classify, having to sell assets to pay, expenses and stuff like that. If prices stay where they are for 2 years, what share of farmers would be forced into solvency problems? Less than 5%, 5 to 10%, 10 to 20, 20 to 50, over 50, and then F unsure. So couple minutes here to answer that question, and then we'll share that result as well. All right, I think we're there. So I'm going to end the poll, last call, share results. Okay, so over half of you responded that 10 to 20% of our Missouri farmers would face significant solvency problems if output and input prices stayed where they are today for 2 more years. So thanks for participating. We always appreciate and enjoy getting some audience feedback today before we start. We'll have maybe some opportunities again at the end, but I want to go ahead and introduce our guest speaker today. Dr. Courtney Cowley joined the Federal Reserve Bank in 2015 as an economist and was promoted to senior economist in 2021. In 2025, Dr. Cowley began her role as branch executive at the Oklahoma City branch office. As the Oklahoma City branch executive, Cowley is the bank's lead officer and economist in Oklahoma. She recruits and works closely with the Oklahoma City branch board of directors and is responsible for briefing the Kansas City Fed president on economic trends. She also serves as special advisor on agriculture to Governor Mickey Bowman at the Federal Reserve Bank of Governors. Or Board of Governors. Cowley's team conducts research and surveys on key regional issues such as energy, manufacturing, and migration. Dr. Cowley holds a PhD in agriculture economics from Oklahoma State University, as well as a master's degree in civil engineering from Colorado State University, and a bachelor's degree in biosystems engineering at Oklahoma State University as well, where she was named a Henry S. Truman Scholar. Dr. Cowley, along with her husband and 7-year-old twins, live on a small farm in northwest of Oklahoma City. Thank you, Dr. Cowley, for being here. And with that, I'll turn it over to you for your presentation today.
All right. Thank you so much, Ben. Really excited to be here with everyone. Can you see the right, okay, let me duplicate that. Oh, there we go. All good?
Yep, that's perfect. Thank you.
Thank you. So thank you all for being here today. It's always a pleasure to discuss economic and agricultural conditions with agricultural lenders across our district, including Missouri. Of course, we have to share Missouri with the St. Louis Fed, but it's a very important state as we look at the agricultural landscape and what's going on. So just really happy to be here with all of you today. So as Ben said, we're going to talk about navigating the 2025 economic landscape and its impact on agriculture. Last month, I was at a ag conference in Mississippi, and kind of the theme of my presentation was for the theme for the year, I think, both for the economy and the agricultural economy is, we have a lot of risks, but we also have, I think, a lot of resiliency and a lot of the indicators that we track. So we'll talk a little bit about that today. But I will mention that the views I express here today are my own and do not necessarily reflect those of the Federal Reserve Bank of Kansas City or the Federal Reserve System. So with that, we'll get started. And the U.S. economic growth has slowed but remains solid overall. So the structure of this presentation, we'll start out with a little bit about the Fed and the work that we do here. And then I wanted to cover the macroeconomy broadly. And then because we're talking about navigating this economy and what the impacts are to agriculture, we'll finish up the presentation with a specific look at the agricultural industry up within Missouri and the region more broadly, but also the U.S. farm economy. So overall, we think about the macroeconomy, especially at the Fed, because of our dual mandate. We look a lot at the labor market and employment, but also at inflation. So we'll talk about some of those things. And overall, the labor market remains solid. Unemployment is up slightly, but remains near long-term averages. Now, I will say that the latest employment readings that we got did not include some of the layoffs in government employees. So that's something that hasn't come through in the overall kind of macro employment and unemployment indicators, but we will get a better sense of that in next month's readout. But for now, as the data stands, everything still remains very strong. And we are also operate in a very large economy. So, even sometimes large layoffs will make a difference from a macro perspective, but not as much as, what the effects could be more locally to where those layoffs occur. Inflation remains elevated despite coming down from 2022 peaks. We've had just very sticky inflation, both in the broader economy, but also in agriculture with our inputs. So we'll talk some about that. And so as in response to some of these macro developments, the Fed lowered the overnight interest rate for the first time in 4 years in September 2024. Of course, we kept things stable at our latest meeting. The Federal Open Market Committee decided to hold interest rates constant. But kind of more locally in the farm economy, financial conditions have shown some signs of weakness. Farm debt has also grown notably alongside production expenses that remain elevated. So far, though, loan quality remains strong. I thought that Ben's poll question there at the very end on solvency was interesting and kind of highlights, when we start to see signs of weakness. I think his question about if prices stay where they are, how that could affect solvency is very interesting to track, because the last downturn we had in the agricultural economy from about 2014 up until the pandemic, I think one of the common themes through that was that we saw pretty large, substantial declines in farm liquidity, but that farm solvency, and a big part of that because of farmland values, stayed very strong. We're in a completely different environment now, though, I think, because of production expenses, how high they are, given the level of inflation that we've had. So I think that it will be very important to monitor those conditions this time around, because any decline in prices, and if that continues with the level of production expenses we have this time around, I think things could deteriorate at a faster pace this time. So first, I wanted to talk a little bit about what we do at the Fed, what I do, what we do, why we're here. You're probably going to hear a lot about us in the news. And so we always like to, tell our own story from the inside. And so I wanted to just start with that. So at the Federal Reserve, we're spread out across the entire country. I work for the Kansas City Fed, which, as you can see, is in tan on the map, which covers a 7-state region right in the middle of the United States. I don't have it on here, but we have looked at different indicators. So our region, of all the Federal Reserve regions, if you look at share of total personal income that's attributed to farm income, it's the highest of all the Federal Reserve districts. And so we put a lot of resources and effort into monitoring and doing research on the agricultural economy. And so I sit in Oklahoma City. As Ben said, I'm an Oklahoma City branch executive, but I did start out in our Omaha branch right out of graduate school, because that's where a lot of our ag team and our ag work is based. But we do now also have an agricultural economist at our home office in Kansas City who I work with closely. And everything that I do is in support of the first listed of the 5 primary responsibility areas of the Federal Reserve. So I work in monetary policy, both in my work for Kansas City and our bank president, Jeff Schmidt, who sits on the Federal Open Market Committee, but also in my role as an advisor to Governor Bowman. And so I help bring an agricultural voice to Federal Open Market Committee monetary policy deliberations. And I do that through data and research. I do that through just keeping up with what's going on in the agricultural economy. And part of that too, a lot of reading, but also part of that is interacting with stakeholders in agriculture. So farmers, agricultural lenders. That's why we feel like events like this are so important, not just to present to you, but also to see, what are you curious about? What are your questions and comments? And of course, also really enjoy interacting with our land-grant university colleagues like Ben and others in our district, but also more broadly. The Federal Reserve is also very active in financial system stability, banking supervision and regulation, payment system safety and efficiency, and then consumer protection and community development, which we do out of each of our branches and in Oklahoma City. We also do a lot in terms of economic education for students and adults as well. And so we have our Board of Governors in Washington, D.C. That is our government arm, so to speak. My family thinks that I work for the government. I actually don't work for the government. The reserve banks are semi-independent, and we operate more like corporations or industry. But the Board of Governors, the government side, has oversight over the independent reserve banks. That's why we're semi-independent. And we have our Federal Open Market Committee, which includes the 12 bank presidents and 7 members of the Board of Governors who are appointed by the president and confirmed by the Senate. And currently, our bank president, Jeff Schmidt, is a voting member. So the bank presidents, except for the New York Fed president, always votes, but the other 11 rotate. But for this year, 2025, our bank president is a voting member. And so the Federal Reserve was established, the Federal Reserve Act, which is what created our charter, established a diffuse private-public structure. So like I said in the blue, I work for the private side, the regional banks. We have our own boards of directors and our own who hire our bank presidents. They sit on the Federal Open Market Committee with the governors. That kind of connects the two of us, along with how the governors have oversight of our operations. And then our public side is the Board of Governors in Washington, D.C. And so, I don't think I have a slide on it, but for those of you curious, we do have one governor whose term is up next year. And so we'll see what happens with that. And then also Jerome Powell, our chair, his chairmanship term ends in a couple of years, but not his governorship term, which are 14 years. So then, this is kind of a slide about our team. There's a QR code here that links to our agricultural page where all of our data and research lives. Our primary focus and our competitive advantage here, because the Federal Reserve is a primary supervisor of community banks and agricultural banks. We host a lot of data on agricultural lending and credit conditions through surveys that we have. We have a national survey of terms of lending to farmers, and we have our district ag credit survey, which some of you may participate in. If you don't and are interested in that, please contact me. And that's a big way that we get information. And then we also use Federal Reserve call reports from banks that they fill out in our research. So we kind of pull a sample of just agricultural banks for that. So these are kind of my team members. We recently hired another agricultural economist who will join us when she finishes her PhD at North Carolina State University. And then some examples of the publications we have and the work that we do, everything from, like I said, agricultural finance is our subject matter expertise, but We also do work on food price inflation, commodity markets, really kind of anything that you could think of in the agricultural economy, whatever the current event is, we're following it. So we'll kind of transition now to talking about the U.S. economy. And despite concerns about a downturn in recent years, the U.S. economy has been very resilient. And let me see just a second if I can. Oh, here we go. So this chart shows U.S. real GDP, which is really the top level macro indicator for the U.S. economy. It measures the amount that we're producing. What is our output for the total output for the U.S. economy? And I included a forecast as of June 2022 in this chart because you can see at that time we were already forecasting a fairly strong, stable economy with GDP growing at about 2% year over year. And then the forecast as of December 2024 for 2005 was kind of back to that June forecast, but you can see where we were, where we ended in 2022, 2023, and 2024 were actually stronger years by almost a full percentage point than where we expected to be in the middle of 2022. So the US economy has been very resilient since then. And then this chart is a kind of has the Fed's dual mandate all in one. So this chart shows total and core PCE inflation. So PCE is personal consumption expenditures. It's the Fed's preferred version of inflation over the consumer price index. And usually if I'm in person at an event, I'll ask who knows the difference between those two, but since I can't necessarily see you, I'll just say that I kind of like personal consumption expenditures too, because you can actually break out price and quantity with that one. Personal consumption expenditures measures how much people are buying and at what price, whereas consumer price index is only the price of products that people purchase and how it moves. So you can, with PCE, you can kind of also track the level. And I actually have some charts later where we split those two out, but so stay tuned. And then the unemployment rate. And then the dotted lines across the chart show the Fed's target for those. So the target for unemployment, which is kind of around the longer run average, which is around 4%. And then the Fed's 2% inflation target is also listed. And so typically the FOMC projections, kind of try to be a self-fulfilling prophecy where in the long term, we're expecting these numbers to be back at their long run average. It's just how long is it going to take to get there? And how much and what magnitude of monetary policy is going to be required to get us there. So, and typically how we see monetary policy moving really depends on which part of the dual mandate is further away from where we want to be. So you can see 2020 happened, unemployment skyrocketed. And so that was when we adjusted interest rates back down closer to zero. And then unemployment got back to where it needed to be, even like undershooting the target range. We had really tight labor markets between 2022 and 2024, and still fairly tight by historical measures. But now we've been, since about mid-2021, we've really been more of a situation where our inflation mandate has been further away from where we needed to be. So that's why we've seen higher interest rates and increases in interest rates, and then now trying to normalize, but inflation just being very stubborn. So this chart shows the other measure of inflation, the consumer price index on a 6-month annualized basis. And I like to show this chart because the blue line shows where we are across the board. This will be the measure that you see printed in the paper. But the other lines, the purple and green lines, show what's contributing to that. If we break that out, what has been driving inflation? So coming out of the pandemic, you see that the purple lines are above the blue lines, meaning that it was really goods, consumers purchasing large quantities of goods, demand for goods being strong, while supply chains were struggling to keep up with that demand, which was pushing prices for those goods higher, particularly food and energy, but also other goods, including, I don't have it broken out here, but durable goods is really what was driving that purple line higher in 2020, between 2021 and 2022. And a big reason for that was because coming out of the pandemic, a lot of people were replacing things like washing machines, refrigerators, those large purchases that are very durable, quote unquote, as opposed to non-durable, smaller goods. But then once we had the vaccines roll out and people started getting out more, there was a lot of pent-up demand for experiences, which are facilitated through services. Also, shelter has been another aspect. So housing costs has been another aspect. It makes up a third of total inflation, and it has been one of the most kind of persistent areas of inflation that we've seen this whole time. The others have been a little more volatile. Shelter inflation has been very stable and makes up a large share of household balance sheets. So that's been made things very difficult and made changes in prices for other goods and services a lot less palatable. So a big contributor to overall inflation was wage growth. And so here we have the average hourly earnings in purple and employment cost index. And so coming out of the pandemic, after we had that big spike in the unemployment rate, we had an equally large downturn in unemployment as companies started kind of coming back online and demanding more labor. And so wages increased because there was so much competition for that labor. But now we're starting to see that come down to more normal levels, but still a couple of percentage points higher than where we were prior to the pandemic. Why did wages have to go so high? This was probably my favorite data series coming out of the pandemic, which showed how tight labor markets were. So this shows US job openings to unemployment, so the ratio of those two things. So for the overall for the US, at one point post-pandemic, there were more than 2 jobs for every unemployed worker. And so the measure of unemployment here is those who are in the labor force but unemployed. There's other unemployment measures that show everyone who's unemployed, even those who are not in the labor force actively seeking a job. But this one shows those unemployed in the labor force. Now for the US, that's starting to come down to where there's 1 job for every unemployed worker, which is really kind of the sweet spot where you'd like to be. And that's similar to where we were just prior to the pandemic. In some areas of our region, though, I know in Oklahoma, our number is still about 1.5 jobs for every unemployed worker. And so oftentimes we see a little more tightness in areas that tend to be more rural. And so what contributed to this tightness? So we're kind of taking the macro indicator and we're whittling down to what was contributing to all this. Well, labor force participation still lags, mostly due to older workers, but immigration rebounded post-pandemic. So in the pandemic, we had this confluence of all these headwinds that just really affected our labor force significantly. We had a lot of unexpected retirements. And the saddest part was just the number of deaths that we had, both in the labor force, but just in general. And then women leaving the labor force to take care of children and parents. And then also our immigration went to almost 0. Those things have since recovered. Even women on the chart on the left, the purple line, our female labor force participation rate rebounded really strongly, starting in 2013 and has now surpassed where we were prior to the pandemic. But we're still, as shown by the blue line, not quite where we were as of February 2020. We still don't have as many people in our labor force as we did at that time. though we're continuing to go in the right direction. So jobs have continued to grow in the U.S. overall, while the unemployment rate has remained low. It started to tick up last year, certainly something to watch. Not at concerning levels yet. Business sentiment still remains really high, but one thing we are seeing is this dramatic divergence between business sentiment, which is very high and still optimistic, and consumer sentiment, which is really declining here recently. So that's certainly something to watch, especially if we continue to see these unemployment levels increase. And so what did the Fed do? The Fed lowered the federal funds rate in December, but revised their projections to only 2 cuts in 2025. And as we know, in January, they also held things stable. So this chart shows the range of projections in purple for the federal funds rate, and the median FOMC projection in both September and December of last year. We don't get these projections in January. Every other FOMC meeting, the FOMC puts out what's called the SEP report, which is the Summary of Economic Projections. So we'll know more about that at the next meeting in March, kind of where they are. But you can see in September, they were projecting lower a federal funds rate in 2025 and beyond. And that was adjusted upward in December 2024. And a big reason for that is just where inflation has been more stable than expected. So what does this mean? What does this all mean for agriculture? Well, first, and we can kind of transition to agriculture by looking at interest rates. And that's the interest rates on farm loans continued to increase through all of 2024. And have still, and we just had, I wasn't able to get it in here, but Q4 data on interest rates, which we now have and are working on, but still, I can say still stable in Q4 from where we were. But this chart shows average interest rate on farm loans by loan type, so loan size, and even for all interest rates, on average, rates have been a little above 8% and fairly stable across both size and type. We do see some regional variations. For example, in Oklahoma, interest rates on farm loans tend to be about 1 percentage point higher than in the rest of our district. I still am not really sure why that is, other than just maybe a little wheat being a little riskier than corn and soybeans, or not as high revenue. But that's a question that I've had that's still trying to answer. But overall, interest rates on farm loans have been relatively stable. At the same time, we've been seeing pretty historically large increases in farm debt. Now, in kind of the first part of 2024, we saw a very sharp increase in non-real estate farm debt. That kind of bounced back later on in the year. But also, to the extent it was so large that we even saw it affect overall loans, even as we've been seeing farm loan real estate debt decline. And that's typically been because of a lower number of loans on the farm real estate side, with just not as much of a supply for farm real estate out there. And then the balance of farm debt outstanding at ag banks has also increased. So the chart on the left shows the change, and the chart on the right shows the overall volume of farm debt outstanding. This is from commercial bank call reports. And so you can see that on the real estate loan side, we've been right at trend for the past 4 or 5 years, where we had previously been operating above trend. On the non-real estate side, coming out of the pandemic, we saw pretty large declines in loan demand and ag loan originations. But that has since bounced back fairly dramatically, as government payments over the last few years were not where they had been. That we're about to get to where that's changing. And then in 2024, just commodity prices coming down while production expenses remaining elevated. And then increases in farm debt have been driven by sharp increases in demand for operating loans. So when we look at these really strong increases in the overall volume of non-real estate debt, almost all of that has just been for short-term operating expenses. As this chart shows, obviously total non-real estate loans have been down. Non-real estate loans overall have grew at a bit slower pace at the end of 2024, but we continue to see really sharp increases in overall operating loans. And that always tells us that's always a story of lower crop prices and, persistently high farm production expenses when we see that. So, but what about interest expenses? So if we look at, I feel a little sheepish when I talk about interest expenses, because in the last few years, back when the Fed came off of the zero lower bound back in, the previous period, and we saw that kind of uptick in interest expenses, we kind of brushed it off and we're like, well, interest expenses are a very small share of total operating expenses. So any increase likely is not going to make that big of a difference. This time around, though, we were like, wow, this is a dramatic shift. So I think at one point between 2022 and 2024, interest expenses increased so much across the U.S. that it went, according to the USDA data, it went from 4% of total production expenses to 8% of total production expenses. So that's a fairly big shift. So I wanted to see, like, let's assume, if we look at the FOMC kind of projected path of federal funds rate, what we tend to see historically, how the federal funds rate affects farm loans, where might we be interest expense wise if interest rates decline by 200 basis points in 2025? And you can see that interest expenses are still fairly elevated, even if interest rates were to come down. And I think now I don't adjust here for, this is all else equal, so I don't adjust for any change in prices or moderation in expenses. This is assuming, let's assume interest expenses stay where they are. Where would we be? So still, interest expenses still being pretty cumbersome for farmers. So what has all this meant for total farm income? So farm income in 2024 was expected to decline, though by not as much at the beginning of the year. And farmer sentiment also reached 10-year lows last year. This year, though, the USDA just released their U.S. farm income forecast for 2025 in February. So 2024 was converted to an estimate. 2025 now becomes the forecast. And you can see that they forecast a very large increase in farm income for 2025. Almost all of that, though, was an expectation of higher direct payments to farmers as a result of the American Rescue Plan, which included funds for agricultural producers. At the same time, farmer sentiment, according to the Purdue University Farm Barometer, has also bounced back slightly. And particularly, so the numbers that you see above zero there have occurred after the election. November was like a big move for the Purdue Ag Barometer, November 2024. And why I like this index is it indexes current conditions. It compares current conditions to where we were in October 2015 to March 2016. So a number of 100 means that farmers pretty much think that current conditions are very similar to where we were in that 2015-2016 period, which a lot of us remember was a very bad time for the agricultural economy. So for most of last year, we were below that in terms of sentiment. We've now bounced back to it, but we're still kind of hanging around that similar sentiment from that time period, and very far off of where we had gotten to in kind of 2021 and 2022. So what's interesting is I had mentioned that overall business sentiment is still very strong. But if we look at farm businesses, sentiment is not that great right now. So farm price to total production expenses. This is a chart where we pull crop prices and compare them to expenses, and cattle prices and compare them to expenses, just to show how different conditions can be based on where you are and what type of production you're involved in. In our district, cattle make up about 50% of farm revenues, and I think I have a chart on this for Missouri next, but so district-wide, cattle are very important, and then kind of corn, soybeans, wheat, hogs. So those make up the 5 top commodities. So on the crop side, prices have not kept up with expenses, and that's what's been driving a lot of that demand for short-term operating loans. But on the cattle side, and in fact, we see much better conditions overall in cattle producing states than we do in states where crop production makes up a larger share of total farm revenues. And so speaking of that, if you look at Missouri, and unfortunately, state level data on revenues and costs are very lagged, but we can, get some sense of conditions by what had been happening. So obviously, very strong run up in revenues. So 2020 to 2022, we had a massive run up in revenues, but at the same time, we were also getting some support from the Coronavirus Food Assistance Program and the Market Facilitation Program. And so that, but the revenues I show in the chart on the left are specifically, revenues from agricultural production. This does not include government payments. But at the same time, costs were tracking right with revenues. And so that kind of took away some of the benefits of what farmers were seeing from those higher revenues, even though, it's super helpful at that time. So Missouri is fairly unique in both the US and our district as a whole. Like I said, our district as a whole, cattle production make up about 50% of total farm revenues. In Oklahoma, it's closer to like 70%. But in Missouri, soybeans and corn make up than what we see in some of our other states, both in the district and overall. Still a pretty good chunk from cattle production, and then also a much larger share of farm revenues in Missouri come from hogs, broilers, and chicken eggs than what we see across the region as well. So those things I think are very important to the outlook for farming and the agricultural economy in the state. So one risk, I'm going to go fairly quickly because I don't know about you guys, but I think every day I hear a news podcast cover the price of eggs. So I think that this has been very well reported on and very well researched, that egg production, and sorry, that's a little mislabeled on the left chart, but egg production, both in the US and in egg producing states, has come down due to avian flu, which has sent the price of eggs higher. And then, these didn't get changed out, but broiler prices too, and across the US have also come down, but we're not seeing quite the price movement in broilers as what we are with eggs. I think interesting there, just the production practices are so different. I read that, and just, broiler chickens are harvested at about 14 to 16 weeks. So they don't really have the time to get sick, so to speak. That production is not located in for whatever reason, egg production is located more in the migration patterns. So migratory birds that tend to carry avian flu have affected egg layers more. Those hens also live longer, so they have more of a chance to get sick. So outside of poultry, though, crops with the most export exposure have seen the largest declines in prices in recent months. So I like these charts because they show kind of the export share of U.S. production. So obviously soybeans, we've been through this before, not too long ago with the last trade war with China. This is why soybeans were targeted, because soybeans are very reliant on exports. We only consume about 50% of the soybeans that we use in this country. Now, I will say that this is an average. If you look at 2024, we actually use 60% of our soybeans in the country, in the US, and only exported 40%. So that did change. Part of that was due to biodiesel, biofuel production. So we'll be monitoring that moving forward. We might be, kind of in an era of using more soybeans domestically, but wheat as well. And so when you compare these two charts, you can see that those crops and commodities, so beef and pork, that are more reliant on exports, at least on the crop side, have seen the largest declines in prices. Pork is a little bit of an outlier because and really meat in general, I think, is a lot more from a price sensitivity perspective. Those prices are discovered differently than in crops and also more reliant, I think, on domestic demand. But definitely for soybeans and wheat, we've seen a lot of downward pressure just related to the export picture. And exports being a fairly significant risk just with what happens. I saw today that the administration is planning to go through with the tariffs on Canada and Mexico. So, 2024 was a bit of a difficult year for agricultural exports because declines, a big part of these declines was from and these data are a little lagged. So it's that 2024 year to date is through November, because when I pulled this, December wasn't available yet for the whole year. But corn and soybean exports in particular reached record levels in 2022, still maintained fairly high levels in 2023, but then fell off a bit more in 2024. And so back to about average levels, I would say, from a historical perspective. But again, when farmers are facing kind of the production expense picture that we're facing, any fall off in demand prices can be very sensitive to that, I think. Particularly because we're so good at producing agricultural commodities in the US, so large supplies are kind of a given, even despite what Mother Nature throws at us. And so we're very kind of sensitive to what the demand picture looks like. And then, like I had mentioned, the last trade war, since the last trade dispute with China's soybeans imports have more moved in tandem with Brazilian exports. And while our US total soybean exports have really leveled off, if you see the blue line there. So the purple line, the blue line is total Brazilian exports. The green line is Chinese soybean imports. And then the purple line shows US soybean exports, which have diverged a bit in recent years. And another headwind specific to soybeans, so we can actually look at soybean exchange and corn exchange rates, and those have kind of diverged somewhat as well. So the dotted lines are exchange rates for our competitors, or the strength of competitors' dollar, so to speak, for corn, and the solid lines are the US. So if you can kind of compare exchange rates for those, we're in a better position when our competitors' exchange rates for their commodities are higher than ours. That means that we have a better potential to be the low-cost producer, and that the lowest cost producer tends to see the highest demand for products on global trade markets. So for corn, we've been fairly well positioned for several years now, whereas soybeans, it's been more difficult for US producers to be that low-cost producer. I had mentioned earlier that domestic demand for oilseeds has increased, so that may offset some of the weaker international demand. We did see this for corn back after the renewable fuel standard was passed. Our kind of food and industrial consumption of corn increased dramatically because of ethanol production. Feed consumption stayed fairly flat and exports stayed fairly flat, but it was really this kind of increase in domestic demand for corn that kind of changed that whole picture and made the corn industry overall less reliant on exports. We're seeing, something kind of similar in soybeans right now, where our exports have fallen off a little bit the last couple of years, whereas the domestic crush has increased. So what does this all mean for credit conditions? So these are credit conditions for our district overall. So repayment rates so renewals or extensions, so demand for renewals or extension has increased, while farm loan repayment rates have declined slightly. And this index means farmers are maybe having a harder time repaying their loans in full, paying them on time, things like that. So it's kind of an early indicator of delinquency rates, but overall credit conditions, as shown by this chart, delinquency rates on farm loans, whether they be agricultural production loans or farm real estate loans, have been very historically low and remain very strong. However, capital spending has slowed substantially while farm household spending has continued to grow. So in the last part of 2024, we saw the largest gap between farm household spending and capital spending. And so as farmer households are facing not only high production expenses, but also very elevated household expenses as well due to broader inflation. So I'm going to skip these last few charts because I want to save time for questions. These are more a bit on the consumer side. So if you look at those and are interested, I'm happy to answer questions or have a conversation, but I want to keep us on time. And I know that really the meat of this today was just more the broader economy and how it affects agriculture in general. So I think you can see some key themes out there that the U.S. economy is still very strong. But really, whether it be, households, the economy in general, farming, inflation just continues to be a really great challenge across the board. So the Fed is taking steps to, weighing, balancing the risk of normalizing, but also monitoring inflation, making sure it's still headed in the right direction. Financial conditions in the farm economy. So we look at and repayment rates have declined slightly. We see other signs of weakness, other risks related to whether it be trade or avian flu. But overall, we're still seeing fairly strong loan quality. So if you have any questions, please ask today, or my email address is here. Contact me. I'm also on LinkedIn. If you want to get to know me more personally, I'm on Instagram. I kind of do LinkedIn for business, Instagram personally. And then if you're interested in signing up for our Ag e-alerts or signing up for our Ag credit survey, more information on that is at the QR code provided. So thank you so much, Ben, for having me. Happy to respond to any questions you may have.
Yeah, thank you very much. That was awesome. And we'll get to a couple here in just a second. I do want to quickly, and I'll put the link to the Fed Ag Alert or the alert newsletter in the wrap-up email. I do want to quickly get to, if I can get this to work there. I want to just do a couple of wrap-up things real quick.
Stop.
Yeah, maybe that would work.
There you go.
There we go. Excellent. Thank you. So as a reminder, our next webinar, well, first off, if you have questions, go ahead and put those in the Q&A feature, and we'll get to those as many as we have time today for. And again, you're welcome to email me if you have questions there as well. As a reminder, our next webinar will be a presentation on spring weather and crop markets. This is always a really fun one for my colleague, Zach Lesser and I to do. We enjoy this. Last year, we accidentally scheduled it for Good Friday. And so we've made sure to miss that this year and hope that everybody can join us for that discussion as well. I joke that one of these days, Zach and I are going to switch topics. I'm going to do weather and he's going to do markets. I don't know if that's going to happen this go around, but regardless, it'll be fun. Come back and invite your friends. The other thing I want to mention is we do have our annual Abner W. Womack conference, which is the Missouri Agriculture Outlook Conference here in Columbia. This is FAPRI's official rollout of economic projections for the next several years and talk a little bit about policy. There'll be two special sessions this year, one on farm policy in DC and one on trade policy and what tariffs mean for agriculture and kind of what if scenarios. This program is free with lunch included, but we do ask that people register so we know how much food to order. The other thing, and you've heard me mention this before, the second announcement relates to our annual University of Missouri Agriculture Lender School. This is a 3.5-day intensive training for new and beginning agriculture lenders hosted every June. Registration is open for 2025. If your bank has hired new lenders, this is an excellent learning opportunity for those team members. My colleague Ryan Milholland heads that up. So we'd be happy to have you all here. And then finally, just a reminder, I put the link in the chat feature as well. I do please politely ask that you fill out and complete our program evaluation today. It takes roughly 3 to 5 minutes. I think there's like 12 to 15 questions. These are important to us so we can continue to design programming that meets the interests and needs of our stakeholders. I always make the joke, if I didn't do a good job today, don't answer it. But no, I kid. Please answer it. Let us know how we can do better to serve you in the years ahead. So with that, thank you everybody for being with us. And we do have a couple of questions. So I will stop sharing here for just a second. So we'll get to it. So Courtney, one of the questions that I got emailed related to what does this all mean for land values in Missouri? Where do you see land values going in the next couple of years?
Yes, I love land value questions because I think these markets have been very fascinating for a long time for our region as a whole. And I think in our region, all the states kind of move together when it comes to land values. Obviously, there's different price levels. You kind of start, Missouri, Eastern Nebraska, Eastern Kansas are the highest value land in the district. And then you kind of move west to southwest. So our lowest value land tends to be in Oklahoma. That's just a productivity, what we can grow type question. And so, we just continue to see real resiliency. And so I think whether it be in Missouri or other places, there just hasn't been a lot of land for sale. So those that have land are hanging on to it. But when land does come on the market, there's always, it seems to be at least 2 buyers. And that's really all you need in order for there to be, fairly strong values. And by that, I mean, there's still really strong demand. And one thing we see both in Missouri and across the board for our ag land is, and this kind of relates to one of the poll questions that Ben asked, is that in our district as a whole, but also in Missouri, still about 75 to 80% of farmland purchases go to farmers. So that's a question that we ask in our ag credit survey. And so we know that there's still a lot of demand for ag land to be in farming. Now, in certain parts of southern Missouri, southeastern Oklahoma, very similar type recreation, we're seeing a lot of pressure from recreation and non-ag uses in those areas. And so those have not only supported ag land values, but also housing values. So we've recently done some research on a first-time home buyer housing affordability, which sounds very specific, but some of those trends, housing has become a lot less affordable, particularly in some of these areas that have very high natural amenities and where recreation demand has increased.
Awesome, thanks. So another question we had come in is how much of the increase in operating debt is carryover debt from the previous year versus net new borrowing?
So that's a great question too. So we continue to see about, because we asked in our first quarter ag credit survey about, has been the increase in carryover debt. I'd have to look at those numbers for this first quarter to get a good sense, but it's usually around, I think we've been here recently around 10%. And so a lot of what we're seeing in terms of the increase in operating debt is actually from new loans. So, I think the charts I showed were from call report data, which is like the stock of lending. So I think that's why I really like this question, because you can think about a stock of lending or the flow of new loans. Call report data tells us how much debt is outstanding, so the stock. But then we also have our National Survey of Terms of Lending data that has shown us that a lot of that has been new loans. So demand for new loans, and most of that driven by larger sized loans. The number of loans has either been fairly stable or actually come down. And so a lot of what's driving that new volume has been demand for larger loans. And that also kind of gives us an indication that that each kind of individual producer is just needing more operating funding through debt.
Awesome. Thanks. Well, I think we're going to call it there. We're at 2:00. And so do appreciate everybody being on. Courtney, it's great to see you as always. And thank you for doing this with us. Congratulations on the new role. And for our audience, we look forward to seeing you at our next webinar on markets and weather. And I'll be sending the information out about the Federal Reserve Ag survey or newsletter. And that way, if you don't get that, you can have the opportunity to sign up for it if you would like. So with that, thank you on behalf of all my colleagues at the University of Missouri for joining us today. We look forward to seeing you around the state of Missouri real soon. Have a great day, everybody.